Hey everyone, Grang Patel here. I just want to talk to you today's topic. I want to talk to you about basically four big investing mistakes that most investors make. And this includes seasoned investors, right? So somebody like me who has about 1 or 2 decades of experience, I am still guilty of this myself. So I see, when I look back on my investing career, these four really ring true. So in short order, they are first one, misunderstanding the nature of randomness. Second one being focusing only on two numbers, the most recent returns and average returns. Third one is underestimating how this is going to change your day to day life. Basically, failing to appreciate on a gut level, having an emotional awareness, knowing in your bones how this is going to affect you. The fourth one is touching your money when you're in a highly emotional state. So, I want to briefly touch on these and just kind of give you a quick synopsis of the four, and then basically give you two bulletproof things you can do to basically protect yourself from making these mistakes. Okay, let's just run through them real quick. So the first one is misunderstanding or not truly appreciating the nature of randomness. So this is a deep philosophical question. If you open up any probability textbook or any philosophy discussions about randomness and you ask yourself, what does it mean for something to be truly random? Okay, so let's just take a textbook example, basically a coin. So if you flip it beforehand, you have no idea what's going to happen, either if it's going to land heads or if it's going to land tails. So that's what we mean when we say that what something is random, that it has an equal chance of occurring or not occurring, that it cannot be predicted beforehand, and that's what makes it truly random, equal chance, equal probability of happening. Now, something very interesting happens when you simulate randomness basically in an Excel worksheet or like, any sophisticated statistical programs like R or even like custom code in Python or anything like that, machine learning. What will happen is if you plot randomness, like say on an XY axis, right, like the Cartesian coordinate, what you'll see is you'll see clusters. You'll see like a little bit here, a little bit there, a little bit there. And if you ask somebody to draw something at random, they might pick the first spot, right? On the XY axis, they might pick something random. More than likely, it's like 3, 3, 3, 7, something like that. And then what they'll do is they'll equally space stuff apart. And so when you look at it, it becomes pretty apparent that that's not random. So intuitively, to a human, what looks non-random is essentially random, and what looks random is not random. And a lot of professors that teach statistics will have fun with their students on the first day. They'll just ask them to either flip a coin and record the results, or actually write down what they think random should look like. And then they'll walk in the room and then they'll be like, okay, this is random, this is not random. So anyway, so that's what I mean by not appreciating the nature of randomness. Basically, Howard Marks, one of our greatest investors of our time, has said that when something is random, it means that it has more ways of happening than actually does happen. So if you look at the distribution, it's wide, but what you see is just one thing coming out, and you think that's the path that it was supposed to take when it could have taken any one of those paths, and you just happen to see the result that you do. So that's the first one. The second big mistake that investors make is looking only at two numbers, either percent returns or average returns. Now, both can be really misleading because another great investor, Ray Dalio, he said that the mistake that people make is that they'll extrapolate the most recent past and project that onto the indefinite future. And we know that that's not what happens, right? There are shocks or what we call discontinuities. Events happen and then they determine basically what kind of a run you're going to have with your money. So that's this part of the second mistake is, and the other one is only looking at average returns and then thinking that's what you're going to get. But right, as we said earlier, if you look at the distribution, more things can happen than actually will happen. So if you look at, say you're expecting 10%, that's on average. So that means like you might either get 3% or you might get, 15% or 18%. So, because the average is 10%. And I'm actually going to show you, I'm going to take you step by step and work it out in Microsoft Excel so you can see for yourself. I'm going to show you how to build a Monte Carlo simulator so you can kind of be prepared for the road ahead so nothing catches you off guard. So the third one is not appreciating how the change in outcome, what we call sequence of event risks, is going to affect your day-to-day living. So, right, so you can think of it as filtering down at 3 levels. The first one is you have a good run or you have a bad run. And that kind of changes if you have a lot of money or a lot less money. And then that filters down to how much nest egg you're going to have. And remember, that nest egg, we're going to turn that into expenses for day-to-day living. So it could mean you could have $10,000 extra per year when you're older and ready to retire, or it could mean that you have $100,000. And I'm actually going to show you that in Microsoft Excel. So we're going to build a Monte Carlo simulator from scratch, and so you have an appreciation for what I'm talking about. So the fourth mistake that people make is they touch their money in an emotional state. And I am guilty of this myself. I have plenty of times when I know what the right thing to do was, and I still did the opposite. And so just know that investing is just as much a mental game, a psychological game, as it is an intellectual game. So the knowing what to do, but actually being able to execute on that is a lot more important than actually just knowing what to do. I'm going to basically give you two tools. Well, one is more of mindset, but the second one is a tool. So there are two things you can do to bulletproof yourself from your money. So the first one is only look at your account once a year. Now, if you're doing something a little bit more aggressive and risky in your risk on buckets, such as options, I say maybe look at it once a month, maybe once a week, no more than that. And there's some tricks I can show you, but that's the most important thing. Don't look at it more than once a year. If you're doing options, maybe once a week. The other thing is just have like some kind of a simulation in place to know what the par for the course looks like. So we're going to go through step by step. We're going to build basically what I call a poor man's Monte Carlo simulator in Excel. And then that's going to show you what the scenario of possible outcomes might look like for you. So when things are going bad, you can always pull that up and say, okay, look, this is par for the course. This is what I signed up for. So it'll keep you from getting into a heightened emotional state and basically making stupid mistakes with your money. So let me show you how to do that, and then let's build one together. Okay? All right, so what I'm going to do is, if you just go here, let's say S&P 500 annual returns. This is a really good website. I mean, when I compared that on a year-by-year basis, I don't think it's super accurate compared to, like, say, Morningstar or Yahoo Finance, but they do have, it's kind of easy to use and it's close enough for our purposes. So I'm giving them full credit. The website's called macrotrends.net. Okay, so we're going to do this. If you go here, and this might take a minute here. For some reason, it's not cooperating today. See if we just reload it, if it doesn't. There we go. Okay. So look at the distribution, right? Green means good, red means bad. Basically above zero, below zero. As you can see, like, what they call 1980s, the great moderation. And, just when you think things can't get any better, you have one of the worst drops in recent memory. So the moral of the story is you should always be prepared for the unexpected. But let's just kind of like take it one step further. We're going to do this. We're going to download. See, and they're saying here, we need your support, blah, blah, blah. Okay, giving them full credit. This is not me. This is macrotrends.net data, okay? Okay, so let's start cleaning up this data a little bit. So then we can kind of have a much better idea what we're doing, okay? Let's do this. So let's just say, we'll call this the year returns since, what's the first year, 1928. Okay, let's do that. Just a little small housekeeping things. This one might need to be formatted as a text. We'll do that. Let's do that. Drag that down. Okay, so what we want to do is we want to convert this to a percentage. So basically what we're doing is divided by 100. Okay, and actually let me zoom in here a little bit so you can see what I'm doing. I think this might be easier for you to see what I'm doing. Okay. This is what we're doing. And maybe even a little bit more. Okay. So you can see what I'm doing. Okay. So this is a percentage, right? Just do that. Yeah, that's good. So let's do that. Drag that down. And copy. Then I'm gonna do a paste special, just values. Okay, and then I'm going to turn this whole into a percentage. Maybe one extra digit. Okay. And then we can delete this. Okay. So I'm going to wrap this a little bit just so I can see it a little bit better. So go to alignment. Let's do center wrap text. Okay. Just going to bold this so it looks a little nicer. All right. And then I'm going to go here and I'm going to freeze panes so we can scroll nicely. Okay. So we have that. Now, okay, what do we want to do next? Okay. So what we want to do is try and figure out that there's a good argument to be made for the fact that the economy of 1920s is not the same as today. So we can look at, and we know that markets, especially stock markets in particular, are event driven. Most of that has to do with interest rate shocks, but also some exogenous shock that happens that precipitates that interest rate movement. So let's just say we can, like, normally when you're doing statistical analysis, it's good to break data up into quintiles, like fifths or tenths. So let's just see if we can make it into like 5 buckets, right? So we can say, what do we want to say? We know the post-war boom, so 1950s was good. So that was another start of another era. We know the Reagan Revolution, 1980s, that was good. We know something bad happened right around the turn of the century, the tech crash, 9/11. So let's say we're in another era. And then typically, and this is what I talked about earlier, most people make the mistake of looking at only recent returns. So let's just see what happens if we commit this fallacy ourselves, which is we only look at last 10, 11 years. So let's just do since 2012. Okay. And what we're going to do is we'll just copy all of this. Let's get this guy out of here so we can see what we're doing. Okay. Let's just drag this over. And then we can start deleting a little bit. So say, since this is 1950s, everything before that we don't need. Delete that. This is 1980, so everything before 1980 we don't need. So let's do that. This one we know is since 2000, so everything before the year 2000 we don't need, so let's delete that. And this is the last 12 years, so everything since 2012 we don't need, so let's delete that. Okay. So now we have raw data that we can work with, and we can kind of see what the history, basically you're talking about a last century of American financial history, so let's just see what's going on, right? Now, we kind of want to get a handle on what we're dealing with. So typically, anytime you have data, what you want to do is look at the shape, the center, and the spread of the data. So in statistical jargon, you kind of want to know the mean, the standard deviation, the median, sometimes the mode. But let's just, so let's do stuff here. Let's do mean, standard deviation, maybe even the median. Okay, so let's do that. Going. So average. Hope you can see what I'm doing here. I'm gonna zoom in just a little bit more so you can see better. Let's do, okay, that should be easy for you to see. Okay, so let's do equals average. Do that. Right. 7.8%. for the last 100 or so years. Okay, now we want to know what the risk is. So it's typically it's captured by standard deviation. So do that. Okay, that. Maybe even let's get the median. Do that. Okay. So right there's a dead giveaway, which means the markets are inherently a lot riskier than economists, statisticians would have you believe. Anytime there's a big discrepancy or a reasonable discrepancy between the mean and the median, you know that you're dealing with data that's not normally distributed. So, okay, let's just do that for all of our 5 buckets. Now we have this. Now we want to kind of see what our risk-adjusted return is. So let's just do this. Let's see what the risk-free rate is. We'll just say it's right now it's hovering at 3.5, 3.7 as of this recording. Just to keep things simple, say it's 3.5. Now I know I'm probably committing a sin here, assuming that the returns were the same back then as they are today, but you know, it's whatever. I'm prepared to deal with that. Okay. Now we want to do is there's something called the Sharpe ratio, which basically what that does is it gives you a risk-adjusted return. So basically what you want to do is take the average or the mean, subtract out the risk-free rate, and then divide that by the standard deviation. So, and this should be a numerical number. So I'm going to change that to number. Let's do 2 decimal places. Okay. So 0.22. So the higher the number, the better off we are. Right? So as you can see, 100-year history tells us that, let's do this so you can see what I'm doing. 100-year history tells us that typically your Sharpe ratio is going to be around 0.22. Since 1950s, the good times, 0.34. Since 1980, the really good times, 0.41. Since 2000, things have been kind of turbulent, right? So 0.16. But then if you only look at the last 12 years, you probably, it's not going to hold going forward, right? So you kind of like, if you look at the average of this and this, you see it's like 0.37, right? That's kind of closer to best case scenario. And there's a good argument to be made for this because we're saying, okay, the central banks kind of have a handle on inflation, so we should see relatively tepid waters going forward. But okay, right? That, who knows? We'll see. But we kind of want to be prepared for basically all eventualities. So, okay, so we have this data. Now we can build, let's just say, call it, change this. Let's just call it raw data, or let's just say annual returns, right? Type color, just so we can make it easy to see. Add another sheet here. I'm going to call it simulator, just because we're going to build a Monte Carlo simulator here, or at least a poor man's one. So, okay, so we have this data. All right. Okay, so now that we have this data, let's see if what we can do with it. What we want to do is, I don't know, I mean, I was thinking of calling it either a simulator or a Monte Carlo, right? Let's change the name, Monte Carlo. So it sounds more exotic and James Bondish. Okay, but just kind of like what we want to do is make it self-evident the 4 big errors I talked to you about, like only looking at most recent returns or average returns and extrapolating that into the future. You combine that with not truly grasping on a deep level what randomness looks like. Basically the distribution of the possible futures or worlds that you're going to encounter, and not appreciating that the impact that's going to have on your day-to-day living. But all those things combined are more likely than not, they're going to make you touch your money and do stupid things in when you're in a highly emotional state, and you really shouldn't be doing that. So let me just show it to you, okay? So what we want to do is, all right, let me zoom in here so you can see what I'm doing. Zoom in. Still do 250%. So, okay. I hope you can see what I'm doing. All right, so what I'm going to do is, let's see what our expected percentage return is, right? We'll pull that from the previous tab. Let's see, and just to make things simple, let's just say, okay, initial, we'll set a certain amount, like 100,000 that we're going to invest. Anything you're going to put in every year, which could be your payment. That's going to be $1 figure. So let's do that. Change that here. Okay. And then let's say your starting age. And let's do expected wealth. Okay. Let's do starting wealth. Okay. So this one, we can just say, which number should we use? No, that's the question. Which return, right? So 8%, 9%, 10%, 6%, or 12%. I mean, if you ask me, I would like to think that either some number from the 1950s or 80s would be more appropriate. Let's just say we're going to be optimistic. Let's just say it's going to be 10%. So that's what we're going to be working with. Okay. I don't know how much you have to invest, but I guess 100,000 is a reasonable assumption. So we'll do that every year. Typically, like 10%, 15% of your salary is a good estimate. So most people, if you're college educated and you're 40s, 50s, you're making close to 100,000. So let's just say we'll be generous and say 15,000 a year. Starting age, I don't know. I'm going to look that up. So yeah, it says 38.1 years. So we'll just go with that. We'll say 38. And this is what we want to figure out. Let's just say we'll do this. Retirement age. I'm going to assume, I'll do another video on this, but I think it's safe to assume that you probably want to maximize risk-free government guaranteed money. So let's just say you're going to wait till 70 to draw Social Security, which is also the age at which you can retire, because you're going to do other things to maximize your health and not just your lifespan, but your health span. So I'll do some other videos on that. And then that kind of touches into the big picture view of the Patel method. So, okay, but so we'll do that. So let's do the formula. Do future value. How many periods? So it's going to be this minus this. How many we did that? How much payment? Now it's coming out of our pocket today. So this is right. We said every year we're going to put in 15,000. Okay. Present value, how much we're starting out with today. Now again, this is coming out of our pocket, so it's got to have a minus sign in front of it if we hope to have a positive number in the future. So 100,000 today. Okay. And then, did we do the present value? Oh, we just did the payment. Okay, let's fix that. Rate. Oh, this first one is the rate. Let me fix that. Okay. We want 10%. Got it. Okay. Payment, like I said, it's coming out of our pocket today, so it's got to be minus sign. Present value, minus sign again, because it's coming out of our pocket. Let me just close this and do this. Okay. So you're saying if we do everything right, we should have 5 million $274,996 when we're 70. But that's not really what's likely to happen. So, and this is the kind of like the big aha moment that I want to show you. So, okay. So we'll just do this. Let's take an example from my family. My grandpa and grandma on my dad's side had 4 boys. All 4 of them had 2 boys. And so, right, so let's just call it the tale of 4 brothers. We'll just make something called, so I know this is true in my family. It was one uncle. Is probably the most successful. You'd consider him an American home run success story. Came over here, got his engineering degree, got his MBA. Successful investor, actually convinced him and his partners to take their company public. HT, Hersha Hospitality and Trust, trades on the New York Stock Exchange. At one point, the market cap was $1 billion. So, and he's a big pillar of the community. Well liked, well respected. He's done great things for our family. So let's just, he's somebody I look up to and I hope to emulate. So let's just say, we'll call it the best of, and then, you know, worst off, and that would be my dad. So let's do this. Do total invested. See what we end up with. End result. We'll do an X here to see how much we put in. We'll calculate our return, and then this will give us our yearly income. So I'm gonna for some reason it's not letting me. Alright, let's do this. Okay. That end result, maybe you would just call it end wealth. X is like what percentage, return, yearly income. Okay. Do this. All right. And then remember we said, I'll bold this just a little bit so you can see better. This one we said, there's something called the rule of 4%. That's really helpful when it comes to planning your retirement. Basically, it just means that if you have $100, don't think of it as $100, think of it as having $4 a year for the rest of your life. Now, the gentleman who came up with that 4% rule has said it's now more like 5%. So I'm actually going to change that to 5%. Because this is going to determine how much we're going to get. Okay? And then let's do an average here, just so we can kind of calculate what we're dealing with. So let's pause for a minute and take a breather. Okay, so what we want to do is now, right, like try and keep this number in mind. What I want to show you is why this is not the number you're going to get. And this is what throws a lot of people off when they plan for their retirement. That's why if you follow me, my Patel method, one of the ways that I talk about, so you should have your objective or your goal, which drives your strategy, which drives your tactics, right? That famous line from Sun Tzu being that strategy without tactics is the slowest road to victory, and tactics without strategy is the noise before defeat. So one of the things I teach is that you kind of want to offload as much risk to a third party that can bear it as much as possible. What that will do, because your number one goal as you get closer and closer to retirement is to secure a guaranteed income, monthly income, and have it be as high as possible, just so you can kind of take care of your kids, your grandkids, travel, whatever you want to do. Okay, so let's work with some numbers here. Okay, so we said that our expected is 5 million, right? 5.2, but more than likely we're not going to get that, and this is why. Let's do something here. So do N, which stands for the number of years. So we'll just do a bunch of these cells here. Okay, and just remember, N stands for number of years. Okay, age, which we're going to start. This is where we're going to kind of build our Monte Carlo simulator. Let's do return. Let's do final. Oh, if I can type today. And then let's see how that happens, okay? Okay, so what we want to do is we're starting out today at this age. And then we'll just basically, oh, sorry, this should be 1. This should be the age that we're starting out with today. So we'll just do this, 38 plus 1, and we'll just keep going down. And it's this plus 1. So we can just drag this down. If my mouse cooperates today, all right, let's see if we can get down to, I'll keep going. This is what we want. Okay, so we're going to do this till age 70. And actually, let me freeze the panes here so we can see better what we're working with. View, go to freeze panes, and so this way we can see what we're working with. All right, so basically, here's where the magic happens. What we want to do is essentially pick a number between, say, 1 and 99. I mean, technically, I should be going out to 99.9999, like, because I'm cheating a little bit here, but not that much. Okay, do that. I'll do that number divided by 100, because what we want is a percentage. Let's just do this for both. All right, right? Okay. Okay, and what we want to do is figure out a return. Basically, essentially, what we're saying is it's random. It's going to be centered around the mean, and it's going to fall. Now, I already told you, right? The data is not normally distributed because there is a big gap between the mean and the median. But nevertheless, it's not completely chaotic. It's not like, quantum mechanics. You're going to have more likely than not, it's going to be around 10%. Now, it's very, very rare that you're ever going to get 10% in 1 year. More than likely, it's going to be like above 10, below 10, but it's going to be clustered around that. So what we want to do is figure out what our return is going to be. There's a special formula in Excel called norm, INV. So this is the probability, remember? And we're going to pull from, we said we're going to do since 1980s, right? So we'll do this. This is the mean. And then this is the standard deviation. So let's see if that works. Yep. Hit enter. All right. And then we got our return. So what we want to do is convert that to a percentage, maybe 1 out. All right. Let's do make it easy for us to remember. So what we want to do is let's do this and see if we can do some kind of conditional formatting. If I can find it. All right, it's right here. Okay, let's do conditional formatting. We'll say a bad year is, well, let's do a good year first. Let's say if it's more than 20%, it's a good year. So we'll do green filled with whatever, dark green. Okay? A bad year also is going to be something like, say, if we lose money, it's a bad year. But how bad? Like, we can afford a 5-10% hit, so it's not too bad. Let's say if it's less than 10%, it's a bad year. So we're going to make that red with red. So as you can see, it's below 10. So, okay. So let's drag this down and see what happens. Okay, before I do that, I actually want to lock the cells, which means that there's an F4 key. If you hit F4, it'll put the dollar signs, and then what it'll do is they'll just lock the cells. So, okay, let's do that. And then drag it down, see what happens. Okay, So as you can see, let me zoom out here just so you can appreciate the whole big picture. Yeah, we'll zoom back in so you can see what I'm doing, but let's just see. Okay, so as you can see, this is a good year. We're going to have, in this scenario or in this universe of the many multiverses that can exist of our distributions, you're going to have more good years than bad, right? And then don't worry about these this rand between, because they're going to keep changing as we hit enter and do things. But okay, so I just wanted to kind of show you, this is one of the many outcomes. And like I said, we'll do 4. There's the 4 brothers. Okay, so this is what we're going to do. Okay, so do this equals 1 plus this times what we're starting out with, right? This is our number, remember? We're starting out with 100,000. So this is just it for the first year. That's what we're going to get. All right, let's change that a little bit just to make it easy to see. We'll do it this way. Okay, so now what happened is we have this from last year plus our savings. So that's going to go into, lock that so we can always add that every year. Okay, so we did that. Our savings plus what we ended up with, and we're going to do that 1 plus the return, which was L4. Okay, same thing here. Let's do this, change it. Okay, so this should make intuitive sense to you, right? We started out, let me just zoom in so you can see better. Okay, so first year we started out with 100,000, but you know, we basically broke even. There was no money. It's like minus 0.2%. So we lost 20% of 1%, just like flat. It's a flat year. So you essentially end up with $100,000. But then you also had your 15,000 that you saved for that year. And then we had a good year. We had almost 11.3 some percent. So let's just simplify, keep 10%. So there, you know, 100 plus 15, 115 times, and we can just check our math here too. We'll just do it this way. Let's see. So we did 115,000 times, right? 1.113, 11.3%, right? So there you go. That's the number. Close enough, right? Because, I mean, this is not showing the exact rounding that I'm doing. I'm rounding things up and down to keep things simple, okay? So we did that. So same thing next year, right? What's gonna happen is, I'm clicking on it so you can see here, right? We took that number that we ended up with last year. We're gonna add our 15,000 right here, and then multiply by the return for the year. So did that, okay? So let's just drag this down all the way to see what happens, right? And if you remember, we said we're expecting 5.2, but we're never going to get 5.2. We'll either get something a lot better or a lot worse. So here, I mean, this year, in this universe or outcome, we got lucky. Now, one thing we want to do is try and figure out the rate of return we're getting. So the way we do that is there's a special formula in Excel called RATE, rate, that tells you what you're ending up with. So let's see, number of periods, which will be here, right? And here, let me move over so you can see. Payment, how much did we make? Well, first year we didn't make anything, so we'll skip that one. Present value was, actually this is first year, this is what we always start with, right? So there's that. Go back. This future value is this, what we ended up with, which is, so it's M3. Okay, you just close that and see. Okay, so again, this is where things should start become apparent to you. Like then the first year, we were promised, but we were told we would get 10.1%, but right, there's no such thing. You got 6%. So, okay, let's do this a little bit better. Same thing here. Do rate. How many periods? This is the second year now. Okay. What do we put in for payment? Oh, sure. We put in 15,000. That's what we're going to put in every year. So we can just lock that cell. B4. What do we start out with? Well, we started out with 100,000, right? There's always that. So we can lock that too. And then what our future value is. So in this case, it would be N4 for this one. Let's just do that. Okay. Okay, so let's see here. Just want to make sure we have everything correct. Number of periods, which will be here, the blue highlight, H4. Payment, present value, right? What we put in every year, what we're starting out with, what our end wealth is, what we end up with, and then just put that there. And we just drag that down. So, okay. So this year, in this scenario, things were good to us. We made 14%, which is good. Now, keep in mind, this is also because we added money over the years, so that changes things a little bit. But here, so I'm going to zoom out now, just so you can see what happens if we change it to the four brothers scenario that we talked about. All right, so we'll just do that. Say we'll do this here, here. Again, I'm going to zoom out a little bit. I'll zoom back in so you can see what I'm doing right here. So this way, we have our four scenarios. Just making it a little bit easier to see. Okay? That here. Okay, and now let's take a summary of basically what we're working with. So we talked about the best off and the worst off, right? So zoom back in so you can see what we're dealing with. Okay, so total invested is pretty much just simple, what we started out with, right? Plus number of years, so it should be this minus this times the 15,000. I think I need to fix one parentheses. All right, so let's just see if our math is correct. That makes sense. Let's pull up the calculator. Let's see, 70 minus 38 times 15,000 plus 100,000. Right, so that's good. Okay. So this is the end wealth. We're going to do the best off and the worst off. This is the same for everybody. All four of the brothers. Nope, actually, that's not what I want. Okay, all right, so we got that. Now this is where it gets interesting. What we want to see is what the min and max, or basically the best off and the worst off brothers look like. So this is the end wealth, right? So what we're going to do is, since this is the best off, we're going to do the max out of these numbers. So bear with me here. We're going to do this guy If you hit the control key, you can just select multiple cells at the same time. So that was the first one. This is the second one. This is the third one. And this is the fourth one. I'm just going to lock these cells because we can just apply the different formula to the same cells. Okay, so do that. Okay, so let's see what we're working with. Okay, this is the best of, right? This is the best brother. This would be my uncle. Let's do the same thing here, and then we'll do min. Now this would be my dad. But you should not let that discourage you because, you know, at the end of the day, this is like, let me show you. So let's see, this is what we got versus this is what we put in. So what was our X factor? What was our multiple? So again, for somebody like my uncle, it's going to be a big multiple, right? He basically 6 times his money. What does my dad do? 2.5. So it's still not bad. You still made money. Basically, you put in $1, and that's what, this is the famous quote from Buffett that I just really love. He says, think about what investing is. You're investing $1 today. You're putting it away today in the hopes of getting more than $1 in the future. And if you do that, you're investing well. So this is, you know, it doesn't matter what the outcome is. Like, you can't, you know, tear your house down looking at somebody else's palace or mansion. It doesn't, like, you still did good. So regardless, investing is good. So, and then let's look at our yearly income. This is what I was talking about when you have to kind of feel it in your bones that what this kind of something that happens because of no fault of your own can drastically and dramatically change your day-to-day living. So let's do that. Lock this. And so get this, right? Same here. Okay. So look at the big difference here. You have somebody. Look at what the X factor is, right? Here, this divided by this. You could be 4 times worse or better off than somebody because just something that was completely out of your control. You didn't choose this distribution, this what they call sequence of events or sequence of return risk. You didn't choose this, but you still have to live with it. So, you know, this is one of the. That's why I was saying this is one of the 4 big mistakes that investors make, and this gets them into trouble. So you kind of want to avoid these things. Okay. Now, here's where we can calculate our return, our good old rate formula. So do rate, number of periods, how many was that? It's basically this, 70 minus 38. Okay, do we make payments? Yes, we did. Every year we put in this much. We can lock that because it's the same. Present value, how much do we start out with? Is this. It's the same for all cells. So there's that. And now we do future value, which is this. Well, it's different. So let's do that. So as you can see, my uncle got a 12% return, whereas my dad, it's not calculating his. Sometimes Excel does this, where you're going to run into some problems. So, okay, so yeah, let's just let's calculate. Let's do this again. So, right, somebody well off gets 7%. Somebody worse off gets 5%. Now, this is kind of what you have to keep in mind looking back. This is the most important number. So let me highlight this in green or some bright color if that makes sense. Okay, this is what we're after. This thing, right? Basically a doubling of your yearly lifestyle. And this is what happens when you can least afford to do stuff, right? One of the physicians that I like to follow is Peter Tia. He's the physician to the likes of Michael Dell, the billionaire founder of Dell Computers, Chris Hemsworth, you know, Thor, Lance Armstrong, Hugh Jackman. And so he has a pretty good podcast out. Basically, it's all about maximizing health span and lifespan. And, you know, he has a thing where on the podcast, he said there's no such thing as a healthy 70-year-old. Actually, it was Matt Caberlin, one of his guests, who said that. But you get the point. When you're that old, you're not really going to be able to do anything as well as you can today in your 30s or 40s. So you kind of have to be mindful of that, and then to see how this impacts your yearly living, right? If you can live doubly or twice as good as somebody else just because of something that happened that was not in your control. So, like I said, okay, so recap, those are the four big things that throw a lot of investors off. And they feed off of each other. So it's like not understanding randomness, only looking at tunnel vision with recent returns or average returns. And then from there, not understanding the sequence of event risks you can face, right? So like you kind of you're going to have a difference in income, lifestyle that could very well happen. So we were promised this 5 million, but actually what we ended up with either is 3 million or 1 million. And so that can happen, and we just have to be prepared for it. That's the nature of investing, right? Risk and return go hand in hand. There is no other way. So I hope this was helpful. I'll talk to you soon about a bunch of other things I want to explain and go over. And if this was useful to you, please share with others. Please like and subscribe so you get more videos like this. Okay, talk soon. Thanks. Bye.